Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin monthly update for June 2024. As usual, we're putting this presentation together for our valued clients of the Ainslie Group, which includes Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. Today, we welcome our usual guests, Joe and Paul, to the panel. How are you going today, gents?
Very good. Thanks, Chris.
Good, thanks. How are you, Chris?
I'm going very well. Now, we've got a lot to discuss today because it's been one of those interesting months where, it's sort of a little bit up, a little bit down, a little bit of confusion entering into the market. So we'll discuss all of that. But before we begin, just a reminder, everything that we say in this analysis is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Okay, so we've got our format in place. We'll start with a big picture. We'll work our way down into the nitty-gritty as we go and end up on our simple trading plan, which will help you to take advantage of these cycles. So let's start off, as we always do, with the biggest of all pictures, which is where we are currently in the global macro cycle. Now, this is our global macro cycle indicator, just been updated within the last 24 hours, so very fresh, with a new mid-cycle point added there for the May data. So for June, we look at the May data. Now, we've been discussing this a lot internally because, as I said at the start, there's a lot going on in the markets, a little bit of confusion starting to enter. I'm going to start off with you, Joe. Give us your take on what this means, that we've got sort of this sideways mid-action that's well below that halfway line.
Yeah, so based on that new little green arrow there, we're still chopping around in that mid-cycle part of the economic cycle. Going forward, I'll just quickly reference this will make a lot more sense when we go through the presentation, when we talk about growth, inflation, liquidity, and that. But the fact that we are chopping up and down and a little bit between early and mid-cycle makes complete sense to us. Our job is to live effectively in the future and predict where this chart is going to go going forward. And based on the rest of this presentation, what else we're going to look at, we do expect over time, particularly in the second half of this year, for that to start ticking up as growth and inflation starts to pick up.
Paul, when you look at this, I know, we discuss it very frequently. We're always sort of looking at it. We expect, as Joe's just said, this to go up. What are some of the things that you're looking at that make this consistent with your expectation that it goes higher from here?
Yeah, I mean, these cycles are ultimately about growth and inflation, right? And as we're seeing week to week with this market chopping around, it looks like it's growing, then it's not. It looks like inflation's coming off, no, it's not. So that is playing out in this chart. So we're remembering the early cycle is improving growth and decreasing inflation, and then the mid is improving growth and increasing inflation. Well, we're seeing that chop around, right? So, and we'll talk a bit about growth shortly, but even amongst the different indicators out there, some are showing stronger growth than the others, and then you've got the different components. So it's pretty consistent with the choppiness we're seeing in the market, and probably playing out a little longer than most other cycles. But again, we're coming off a pretty unprecedented high as well.
And really nothing there to indicate certainly late cycle yet, and also bust. Like we're not in that zone right now. So regardless, and this is a point we've made several times, regardless, being early or mid-cycle is the place where we want to be for the types of assets that we're talking about. So we're still clearly in that area. Whether or not we're specifically in mid-cycle or early cycle is probably less relevant at this point specifically. You mentioned growth, and that's a good place to start. Looking at the US growth, because that's obviously the most quoted sort of metric, we have two ways we look at it. We sort of look at the manufacturing side of it and the services side of it. We've got our 1 month leading indicator there. A lot was made in the market, sort of in the, whether that was on X or in the press, about the ISM manufacturing dropping below a little bit there, what was expected. It was a lot of hype around that, really. What's your take on that, Joe?
Well, I think that's exactly why we've included the services and the manufacturing part of the ISM going forward for the rest of our presentations. We've been grinding out really a bottom for quite some time now, and a lot of people would as we've discussed before, have expected that recession to come, whereas arguably services have been what's holding up the economy, the expansion in services, while we've had that slight contraction in manufacturing. Effectively, what we're seeing is that they're balancing each other out. And relating that back to the previous chart, whilst that is grinding at a bottom, and we expect liquidity and growth to expand in the later half of the year, we would expect this chart to actually start to turn up in the second part of the year as well. And yeah, same again with this chart, grinding at that bottom. Election year, in this election year, we expect that the fiscal tax will be turned on, the debt will need servicing. The last thing Yellen and Biden want is for the economy to completely collapse at the closer it gets to an election. So we do expect that to turn up in Q3 and Q4.
And we saw on Friday too, Chris, and the market reacted quite strongly to it. So this is the ISM PMIs that we're looking at, but there's a number of contributors. So there's the S&P as well, there's market. So the S&P figures came out pretty strongly on Friday. So that's consistent with, draw a line, it's a pretty flat one, but it is, whether it's blue or pink or green, they're generally trending up. Okay, and that's what we're looking at. And I guess that green line is services. That can often be a little bit of an forward indicator of inflation as well. So another indicator that we may be going into that mid-cycle and contributing to that of the inflation piece.
And I completely agree. I think it was well overblown when you just look at it visually. You say that blue dot is not really tanking. It's just performed below 50 being, to clarify for everyone, that's the sort of dividing line between expansion and contraction. But we're not rapidly contracting there, and it's only one data point. Everything, even our forward-looking 3-month indicator here, is really pointing right on the line. It's in some ways kind of the Goldilocks zone where the economy isn't running hot. No one's going to argue it's running hot, but it also isn't crashing. So that can be still a good indicator that there's good times ahead. You mentioned inflation. Let's jump to that because that is the other part of this story. Our inflation indicator is really quite interesting because our leading indicator has been below for a long time now, like we're talking really at 12 months below the rate. It's still sitting there. We haven't seen inflation really take off. A lot of people are expecting that to be the case. I'll start with you on this, Joe. Is 3% the new 2%? Is this just where we hover now?
Yeah, so looking back before COVID, 2% was a target, was effectively the Fed's target, and they really struggled quite a bit to achieve that, even through programs such as QE and lowering rates and whatever else they're using at the time. So I think now it's somewhat of a blessing in disguise that they're able to maintain their 3% or thereabouts, where they allow the economy to run a little bit hotter. Particularly if we're looking into the future where we're potentially going to see lower rates, and you've got that negative real yield allowing the debt to effectively be inflated away. So 3% in my eyes is certainly a realistic target of what the Fed would in the long term be happy with.
Paul, can you just dig into that? Because Joe's just said there, it's a blessing in disguise having this higher rate of inflation. Now, most people wouldn't feel it as a blessing in disguise. Why does the government see it as a blessing in disguise?
Government's got a little bit of debt, Chris, and
just a wee bit.
So when you're sitting on nearly $35 trillion of debt, we've said this a few times that you only have a number of ways to get rid of that debt. That's to pay it back, and that means strong growth and actually pay it off, and God forbid not deficit spend, or you can inflate it away. So for them, for the value of the assets against that to get inflated away means it helps get rid of the debt. Now 3%'s hardly startling, but it's better than 2 by 50%. So we've come off high inflation. 3 is probably hard for people, and we're seeing that with cost of living pressures. But if they can get away with it, and they're in this sort of, as we've just seen, that neutral sort of growth zone, then they're probably getting away with it, and they'll probably try and keep it there for a while longer, I think.
And just to be clear, when we're talking about negative real rates and the inflation actually helping the government, so if rates were to come down to say 2%, and they were and the government was able to borrow and issue bonds around the 2.5% range, maybe a little bit higher for long dated, and there's inflation of 3%, so that they're actually inflating the debt away because they're borrowing at a lower rate than what inflation actually is in the real economy.
And that seems like a perfect segue into looking specifically at the debt and yields, because we sit and look at this quite a bit. We go, the debt line, the white line here, is ridiculous. Like, we all acknowledge that. We believe we've passed the point of no return where that just keeps going up because the funding of that leads to more debt and so on and so on. This becomes really tricky, and I'll zoom in on the next chart, which just looks at the same data but a little bit closer. We are sitting up here with yields that have been remarkably stable, to be honest, when you look at it historically. They're sitting up relatively high. It looks like they want to roll over. If we issue more debt, the logic would tell you that the yields run higher, because as supply comes onto the market, to get people to buy that debt, particularly in the current environment where it seems people don't really want to buy the debt, they need to offer higher yields. But we've got this red line, which is the Fed funds rate, which there's a lot of talk of that they want to lower that. They want to lower it for interest reasons. There's lots of reasons why they want to lower that. It seems like this doesn't really line up in terms of what they need to do and where it's sitting. I'll start with you, Paul, actually, on this. What's your take currently on this setup? Is it that we end up with much higher yields? Is it that they have to come down and they find another way to bring them down? How do you view it?
That's the real risk. When, again, because of that amount of debt and the funding of that debt, and again, talked about interest rate costs now exceed defense spending in the US. But probably the elephant in the room is from the buyer side, is that we're seeing sovereign nations step away from the plate a bit. So as we see less demand, then we're going to see that bond price fall, and of course the yields go up. So and they'll continue. We've got an election coming up. We've got a treasurer that likes issuing bills, so the short term bills up front, and that's going to put more strain on it again. So, and that's from the supply side. So there's plenty of upward pressure, but they can't allow that to happen. So it's a tug of war, which will be interesting to see how it plays out.
The can't allow it to happen side, Joe. Like, I've been of the view that there's other factors at play, and that it doesn't just come down to what the Fed funds rate is. I know there's a lot of commentators out there who, they're hanging everything off what happens with rates. Do you see it that way? Is there more to it from your perspective?
I think, like, from my perspective, I'm a little bit different to, I guess, what most people are thinking in terms of that bond market blowing up in liquidity. I'm thinking in the short to mid-term, where the government, if it needs to finance itself, for example, they issue bonds. But at the moment, I had a quick peek over at the TGA balance, which is nearly sitting at about 800 billion at the moment. And then, as Paul mentioned, there's a lot of short dated issuance in the form of T-bills, which are short dated bills that generally get funded by directly out of the reverse repo. So there's numbers on that. They're sitting at about 420 billion in cash at the moment as well. So there's effectively 1.1 trillion there that could the 780 out of the TGA can be spent straight into the economy. So that's as if the bank account's already loaded. Then you've got another 420 billion there to be swapped straight into T-bills if the government needs to fund themselves, and then short to mid-term going forward. So I don't necessarily see any large problems in the bond market going forward over the next few months leading to the election. I think, more to your question, you're talking about rates mattering, referring specifically to markets. Is that sort of where you're going with that?
Well, it just seems to be a common theme that comes up in everything that you read, or whether if it's on your X feed, you've got people saying, well, this will happen if they lower rates, this will happen if they raise rates. this will happen if they keep rates the same. It seems like that's their core factor that they're taking into their consideration. They're not really looking at the broader picture, in my view. And I think you sort of see it the same way. That it's not rates matter, but they're not the whole picture.
Yeah. So from our point of view, when looking at rates in terms of we're basically just looking at assets. We invest in assets. We buy when they're low, we sell when they're high. So I suppose if you're looking specifically at rates at the start of the year, there was 6 cuts priced in after I think it was the November meeting last year. Everyone was quite dovish. So 6 rates were priced in, and now we've moved to about 1.8 rate cuts for the rest of this year. Obviously, we haven't had any yet. So I suppose when you're looking at assets, for example, look at gold. Gold's done quite well. Bitcoin's up 50% since the start of the year, and that's all in the face of rate cuts going from 6 cuts to 1.8. So there's obviously other drivers there outside of what the Fed's doing in terms of its cuts.
We believe very strongly that the liquidity cycle is driving all of this. It's a core tenet of our belief because, well, not just our belief, we believe we can prove it. So it's very important. Sort of starting us off to look at how the two influence each other, we usually start with this idea here that global liquidity is actually a big thing. I just think it might be useful, maybe, Paul, if you could just give us an overview of what global liquidity is in that sort of simplified version that this chart represents here.
Well, and it's probably just coming straight off all that rate talk. Okay, so global liquidity looks beyond what the Fed or other central banks might be doing in terms of rates, because it's ultimately about the balance sheet capacity of the finance system, and that's what this graph speaks to. So whilst we speak a lot about central banks, that's that little black line down the bottom. A lot of it's around the collateral piece. So how much money can get around the system, and it's often off sovereign bonds, and so it's around the volatility of those bonds and then or the lack thereof. So less volatility, so low in the move index, then you get a higher collateral, you get a higher multiplier of the available funds around the world. So the fixation on the rates is probably overplayed from a liquidity point of view. It's really and again, you can see this sideways movement, which has been reflected on a lot of what we've spoken about, because we are seeing a bit of normality around the bond market now, and we've got a few central banks cutting rates, and so that does help. But that's what this chart's ultimately about. It's about the capacity of the amount of funds that can flow through the finance system.
And we'll come back to this point in a second. The collateral multiplier aspect, it makes a lot of sense when you think of it like normal debt, like a normal household. If you have a good credit rating, or if you've got a stable job, and when things are going well in your little bubble, in your household, banks are willing to lend you more money because they look at you as a whole picture. They don't just look at one thing, your income or anything like that. They look at the whole picture in terms of how much they're prepared to lend to you. It's a very similar story when you think of it at a global scale, that you've got, when things are going well, when the economy is fairly stable, people are prepared to lend more. So that's where this collateral multiplier comes into play. And it's a really important distinction, as you've highlighted, that it's not just about this little, the central bank aspect. It's also about what everyone else in a very large economy is doing and capable of doing, that we need to factor and take into account. I mentioned before that we believe we can prove that global liquidity drives world financial asset prices. We've shown this many times. It's the correlation calculations, really. You can dig into that a little bit closer yourself if you like, but it really is proving causality, that global liquidity is driving world financial asset prices and not the other way around. So it's a very compelling argument, and it becomes probably more compelling when we look at this central bank liquidity heat map. And all this is really doing is showing all the banks down the side. I think there's 90 or so central banks, and gives a sort of color indication, red being withdrawal of liquidity, green being injecting liquidity, and sort of the light yellow being fairly neutral. Joe, the picture is pretty clear when you look at it through this lens, that we're coming out of a tightening regime, isn't it?
Exactly. I would say that the most important thing about this chart is establishing the trend, and we've gone from that extreme tightening period from central banks during when we had those high inflation of 2021, 2022, into somewhere now where we're seeing inflation come down and looking to stimulate growth. So you're starting to see central banks easing, not necessarily in the form of rate cuts as we've discussed, but in the form of more liquidity being added to the financial system, which of course has an impact on assets and the real economy.
Such a good point, because there's more than one way to skin this cat, right? Like, it doesn't have to be rate cuts, and that's the point that we're making. It can be many other ways to do it. When we look at that liquidity at a weekly level, Joe, we had this little bump in the road that you talked about previously. Do you want to just talk us through that one? Then, Paul, I want to sort of come to you after that to say what this is representing, this sort of sideways move we've had in the last couple of weeks. But start us off, Joe, with what actually happened that caused this little dip.
So that initial dip in April is what we called the air pocket, where we had tax time in the US. So money was coming out of the financial system to fill the TGA, which is the Treasury General account, so they could spend back into the economy. From the bottom of there, of that little dip, we actually saw bond collateral values start to stabilize. So a reduction in volatility in bonds. So you get that collateral multiplier that Paul was talking about. So we saw a sharp rise in global liquidity, and we also saw the US dollar back off a little bit before reaching that high. So obviously since then we've seen particularly against currencies like the euro and the Japanese yen, we've seen quite a bit of strengthening in the US dollar, which has caused which has caused a tightening in the global financial system, and therefore we've sort of back down to nearly where those levels were in April.
And I think you've just highlighted it perfectly. It's these factors that moved it show what we were just talking about. It's not just one thing. In that case, it was US dollar, it was the volatility in the bond market that was causing the up and the down. So this was purely to do with what you would traditionally think of as liquidity, right? Like, we had money that was coming out of the system. The traditional liquidity measure caused that. This was caused by other factors. So you can't just look at it through one specific lens. You have to look at it more broadly. Paul, with this sideways, is that consistent with what we're seeing now then?
Yeah, because what we haven't mentioned is, I think, the elephant in the room right now, probably the biggest contributor, is China. China has demonstrably tightened, and they are very, very large in the market, right? So we've got, as Joey mentioned before, we've got 800 billion in the TGA, and we've got another 400 in reverse. There's a lot of money to be deployed from the US point of view, and we're coming into an election. So, and we're seeing, as I said, the Swiss, Sweden, ECB, and Canada have all dropped rates. The Swiss twice. So we're seeing a tug of war between nations, I guess, globally, and I think what we really need to focus on is probably China, and just see when they start to ease, because they're clearly in distress in terms of their economy, but they have this tug of war with trying to protect the yuan as well. But I think on balance we're going to see China turn, and we're going to start to see that arrow come up, and that'll be the catalyst in my mind anyway.
That's a really good point, and it hasn't been given enough attention, even internally when we've been discussing it. China's always a little bit mystical because their data is not always reliable and free flowing, but it's certainly been identified as a huge player in the current situation. If we had China pushing liquidity in, we would see this line up already. Yeah, we would have seen that gain happening. So absolutely agree. It's been dampening the effect that we've had from the positive situation elsewhere in the world. And we do have to remember the world is more than just the US, and that China is a very good example of why that's the case. Bringing all of that together, Joe, you brought these charts along this week, which I think are really useful. It looks like a mess, looks like spaghetti on the screen. But can you step us through what we're looking at here in terms of global liquidity cycles throughout time?
So each of those lines represents a global liquidity cycle for that period. So you've got your y-axis along the bottom there, and you'll notice that in some periods liquidity rises faster from its bottom than during other times. Now, what's important to note from this chart is that obviously at the moment we're the red line, and historically we've been a little bit slow in liquidity expansion, like global liquidity expansion, which is why we're going through this current choppy period at the moment. And drawing parallels with the other dark lines that are quite similar on the index there, they are all lines that have just all been through what would call a high inflationary period. So you got the 70s, you got 70, 74, and then into 80 the 1880 line that you've got there as well. So generally speaking, if you've just been through a highly inflationary period, the central bank is going to be slower in producing liquidity to the economy and to the markets, because it is afraid of rekindling those inflationary spirits from the previous cycle.
It's a very powerful chart for highlighting exactly that point. When you look back at those periods in history and go, well, okay, this is where they also were slow. You've simplified it. You've got the simplified version here that really just shows you what a maximum cycle would look like, what a minimum cycle would look like. We're certainly tracking closer to that minimum, and the black line in the middle is the average of that cycle. Paul, do you think there are any other factors at play that are also sort of keeping us here? I mean, Joe's highlighted that we're waiting, that you've got the central banks effectively waiting for inflation. You mentioned China, that could be another aspect here. Anything else that you can think of that's sort of keeping us here that ultimately rockets us back up to play catch up later in the cycle?
Well, look, again, yeah, definitely China. I think we're in a regime, I guess, now where we're seeing a lot more fiscal dominance in the market as opposed to just monetary, and that's changing a few dynamics, I think. And the other key thing here, I think that's, a few charts back you showed that data pot. It's too easy to fear that this time's different or that somehow things have changed. And I think the thing we've got to remember about is that causality that's proven, through quite extensive historical analysis of global liquidity. And the fact that we've just seen a lot of, albeit messy, but very, consistent lines going through these dips, that we can take comfort when we look again at this chart, see that it's still normal. Okay, it's at the lower bound of it, but there is enormous potential for it to go up from here, and one could probably expect it to go up from here because of that causality of global liquidity. So it should be reassuring, this chart, to people that are starting to think, oh, there's some conflicting stuff out there, and it's that very same conflicting stuff that's keeping us down the bottom, I'd suggest, because it's a market that's torn in two ways at the moment. But I'd take a lot of comfort from this chart.
What's going to challenge that even further is this next chart, where something looks amiss here, where we've got our orange line, which is monetary hedges, gold and Bitcoin, potentially outpacing the average global liquidity line. I mean, obviously you can place that line in, you can make correlations look however you want. I'm not suggesting that this is highly accurate representation of the correlation, but we have seen significant strength in gold and Bitcoin against the backdrop of stalling in the short term monetary inflation. If we in the form of liquidity, if we see this staying here, is it that we expect the black line to take off? Is it that we're overdone in the monetary hedges side of it? What's the I'll get both of your opinions on this, but I might start with you, Joe. What's your interpretation?
My interpretation is, so just to be clear, that black line is global liquidity, and the yellow line is the combined market cap of crypto and gold. So we're currently sitting at about 16.5, 17 trillion dollars. I think the most important thing to remember, whilst we're starting to get those alligator jaws there, where we're getting that divergence between global liquidity and the monetary head asset prices by market cap. The last 6 to 8, sorry, only over the last 6 to 8 years would you consider Bitcoin's market cap to be a significant contributor to that chart. So, you know, it really does not take that much for that yellow line to continue on its merry way. If you start to see, well, if we see gold and Bitcoin move upwards, which we do expect based on our liquidity framework. So, like, whilst some people look at that and think that's concerning, the alligator jaws should close. I would expect that they actually start moving up together in a more of a parabolic form.
Paul, any other sort of perspective on what we're seeing here?
Yeah, I think in what's potentially made gold go a bit earlier, and I totally agree with what Joe's just said. We've seen this incredible buy-up of gold by central banks. And if we look at where a lot of that central bank gold buying has come from, a lot of it's been through those BRICS countries, BRICS and friends. And that's really something people are going to take note on, because that's you know, the big smart sovereign money looking at again, I talked about that fiscal response from the US. We've seen a response during COVID where, you know, the US created 40% of all the US dollars ever created in 2 years. So when it's a world using those dollars, you can easily see why central banks are starting to buy up gold. And then, of course, we've spoken about the weaponization of the US dollars as well. So we've got a defensive play by the central banks of having more of their reserves in gold. And then, so I think that's played out as well. But I think we're going to see that black line kick up pretty sharply just by virtue of the amount of refinancing that's going to come up on all that debt that's been created literally just in the last few years. So that's not been reflected. You've got to remember just the scale of the amount of debt that was created over COVID and since the GFC, and those refinancing periods, that's going to kick that black line up. It has to. It's math. Yep,
that makes a lot of sense. So it's not that this is getting necessarily ahead of itself. It's that we've got it's anticipating, probably correctly, because maths is maths, that this line is heading much higher. So that's logical, right? Makes perfect sense in that context. We'll now turn our focus a little bit to the macro assets, and we call them macro assets because they're the things we're specifically looking at to optimally take advantage of these cycles. And we'll start with gold, which we've obviously just been talking about. We've got our correlation just showing up beautifully, where we see the cycle highs and the cycle lows lining up very, very nicely with, particularly in recent years, the Global Liquidity Index. We've got the index starting to sort of tick up a little bit now after that period of choppiness that we talked about. If we zoom in a little bit and look at it over the last 5 years, gold here, that's what we were just talking about, has probably moved in anticipation of the coming liquidity before we've actually seen a massive takeoff. Any additional insight around that, Paul? I mean, you've already mentioned the central bank buying. That's a big part of it. Is it? Well, is that really the dominant story? There's not really much more to that story here. It is central banks buying it up because they can see what's coming.
Yeah, I think so. I mean, we've seen it exit ETFs, right? So I think but we've also seen private individuals loading up as well. So it's kind of a Wall Street computer says no, interest rates are high, don't buy gold sort of reaction. And then the people that are looking through that in terms of what then comes next, they're the ones buying up gold, and that's what's seen that price hold up so strongly.
Because it certainly has. And silver, I just want to continue along that theme of questioning because, again, we've got the high correlation shown, and when we zoom in, we've just had this spectacular sort of run in silver. When you look at the average price over the month, it's really getting ahead. Is this is this a smart money play? Is it that people who look at gold and say, well, okay, the central banks are buying up the gold. Everything you've just described, we can see why that's happening. We understand the logic. So we want to get a little bit of additional alpha on that move by moving a little bit further out on the risk curve with silver, because silver tends to be that later to respond, but bigger response when it does. Is that what your interpretation is of what's happening with the silver chart here?
I think we're seeing a couple of things with silver. Definitely people, we're not the only ones watching the global liquidity, right? So there'll be more people understanding that silver tends to come on strong later in the cycle. Now we've firmly established we're early in the cycle. So silver did have that nice run where the gold silver ratio went from mid-80s now to high 70s. But it's staying there. So it's been pretty resilient. And then I think the other thing you've got to play is just the demand side of things from the green energy side of stuff, that where silver has a lot of demand, electronics. There's just burgeoning industries that consume it at the same time. So there's a bit of supply and demand going on as well, I think.
And I'll dig a little bit further into that gold silver ratio aspect. Similar chart. We've talked about this before, that we go, well, okay, if you were just looking at this chart and knew no other history, you would go, well, that looks like it's heading down. And down here means sort of that silver is increasing in value relative to gold. So you go, well, this trend has sort of towards the bottom there, so maybe it's going to turn soon back heading up again. A point we often talk about, these numbers are still very high historically speaking. So it could certainly go a lot further in terms of silver outpacing gold and still not even reach those historical averages.
Yeah, this scale starts in 2019, right? So the last 100 years, it's probably averaged around 45. In 2011, when we saw that last peak in silver, it was 30 to 1. So when you're sitting at 78 to 1, which we are at the time of recording, 30 to 1 is as a median, right? So it could undershoot. 30 to 1 looks pretty appealing.
It's always the trickiest of the charts to look at and analyze here, because there's multiple factors at play, because they're both being driven by similar underlying reasons. But if you can get it right, oh boy, the returns on silver outperforming gold can be quite spectacular. So we'll continue to monitor that space very closely. Joe, I'll turn to you a little bit to dig into some of the Bitcoin analysis, looking at through this liquidity lens. First of all, we put this chart up to show that very high correlation that Bitcoin specifically has with global liquidity. Anything you want to mention about this chart?
Really, our framework is based around liquidity and risk assets, which we've made pretty clear, and plus gold, of course. The correlation there, you've got 0.86, which is a very high correlation between Bitcoin and global liquidity. I suppose the only other asset that has a better coefficient is the Nasdaq, which is about 0.94. But the only reason I would argue is that Bitcoin has a lower coefficient just simply because of the volatility during blow-off tops and the depths of bear market. Otherwise, it would, over time, as it becomes more of a stable asset and more products and financial products are built around it, we'll see that coefficient rise up over 90. And
yeah, it's really interesting when you do understand that the thing holding it down is actually the big rises that it has. It's not really a negative there.
That's right.
In terms of the argument.
And that's why we're here. We're here to take advantage of that as well. So we're tracking global liquidity closely. We're going to see those deep corrections, and we're going to see the buying opportunity, and the blow-off tops. We're going to be ready to be selling into those.
Absolutely. Now we've got the similar. We do the analysis specifically looking at the correlation with our index and looking at the average price over the month. Bitcoin seems to have held up remarkably well. I mean, at the moment, we're sort of sitting just down here a little bit. So when we get our next average update, which will be sort of at the end of this month, I suspect it'll still be sitting quite high as an average price a month. It holding up remarkably well. Similar story to gold there, where we've had a big move and people get really fixated on the short term, but zoom out a little bit, it's pretty impressive.
Well, it is, considering where we would have expected it to be based on our global liquidity standards. So it's only natural that we see a consolidation as global liquidity consolidates over the last couple of months. Like I said, it's performed quite well, even though if you look around all the sentiment gauges, sentiment's quite poor at the moment. I think people's expectations of how quickly and how far Bitcoin is supposed to move in certain periods of time those expectations are a little bit overblown. But I've been very impressed and quite bullish for the mid to long term based on the way that it's held up in this liquidity dip.
And if we've got what we expect to come, it's going to be a lot of tailwinds behind keeping that price there and pushing it higher. So
yeah, well, I think we're going to have to maybe rescale that chart.
You do say that, and I will. I'm just waiting for my next opportunity to rescale it on the monthly data. This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver, platinum, and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard, the security of real-world precious metals combined with the flexibility of blockchain. All right, as we approach the end, we always like to provide everyone with our simple trading plan to take advantage of the cycles. So obviously, we look at everything, and we ourselves, we're looking at trading gold, silver, or Bitcoin, all of it together. But our simple plan that we put forward for people who are just following along at home and wanting to take advantage of the cycle is pretty straightforward. It's looking at that data that we've been looking at, coming to the opinion that we're at the low of the cycle. At that point, we purchase and then we hold right up till we at the high of that cycle. Like that, it's a pretty straightforward plan. Then we sell at the high of that cycle when we have built conviction that it's passed. If you look at what that actually looks like on the chart, we had our global liquidity low back in October 2022. We were definitive on our buy signal on January 10th, 23. And since then, we've been through many cycles. This here is an overlay of 60-day cycles, just giving you an idea over the short term of what's happening. We've held through up till now, and we're doing very well on that trade. Just before I move on to the specifics of that, we've had our day 37 of the new 60-day cycle, day 37 being the high there. We're approaching what we would consider to be the end of the current 60-day cycle. So we're actually pretty close to where we would be expecting a little bit more upward momentum to come. So for those people looking at the short term, which we're not doing here, but if you were looking at the short term, we're approaching that timing position where we would expect probably some green candles to be coming very soon. Looking at the actual numbers, we bought back at 17,179, and that's over 267% currently. Annualized, that's 184%. So very good returns. That's looking at today's candle where it was at the open of today. Very good returns by really just following that cycle, having conviction to buy at the low, having conviction then to sell at the high when that comes. So that's what we'll be sitting here for. Keep watching every month, because when that comes, we'll be absolutely letting you know so that you can take advantage of that if you are trading that from home. All right, we've covered a lot today. As I said at the start, very choppy sort of period. We like to end each of these with sort of a roundup or final thoughts from each of our panelists. So I'll start with you, Paul. Any final thoughts, perspectives you'd like to wrap up with today?
I think just to reinforce what I was saying earlier, I guess a little less fixation on whether the Fed's going to do 1 or 2 or 1.8 rate cuts this year, and really close eye on China. I think it's for me, it's been the biggest influence in this last month on the Global Liquidity Index, and something logic will tell you, and their history would indicate that they will come to the rescue, because they need to keep that machine going. So I think it's one to watch for sure.
Joe?
A lot like I probably said last month, this sideways chop in markets, particularly if you're Paul spoke to gold, I'll speak to Bitcoin. Particularly if you're invested in digital assets, I find that time is probably harder to deal with than price action sometimes. So this long period of time chopping through effectively the same price over the last few months is going to shake people out. I'll say going forward, just take that long-term time horizon and just know that in the future or in the near future that liquidity turns up and asset prices follow.
Absolutely agree with all that. I think my final thought was really reiterating Paul's. I hadn't given enough thought to China. I think that's what the value of coming together each month and discussing in this format is, that we can sort of have ideas and look at them through different perspectives. I think I'm going to need to look a little bit more closely at that, because I completely agree that's a big one that's at play at the moment, and we often forget about it because it sort of sits off to the side. We're very fixated on the US. So I think that's what I'm taking from today. I'm going to go back and dig a little bit deeper into the China story. So thank you very much, gentlemen, for your contributions and analysis today. Really appreciate all your effort and work behind that. We always value feedback and discussion. So you can follow me on X at Tipper Analytics to stay up to date, or to reach out if you have any feedback, anything you want to discuss, and I'll pass that on to the guys as well. We'll be back in July with the next monthly update to reassess and identify what's changed. Until we chat again, good luck in the markets.